Good evening, everyone. Today we'll have a discussion on financial planning and retirement planning, etc. It's going to be a broad, generic discussion, also slightly longish. And at the end of the discussion, if you have any questions, please do ask. I'll be using the help of a presentation alongside to share the ideas which we feel should be there as a part of the financial planning, oblique investment planning. Also, in addition, there are some workings on Excel sheets which would be shared with you. And those of you who want those Excel sheets, we'll put them in the Google group of values network. So where we start. So any kind of a financial planning, oblique retirement planning. There are five broad objectives which an investor, oblique an individual should target, or rather to say, should be focused on. These are the planning parameters or the five broad objectives around which your financial planning, they should conform to these five parameters. One, tax efficiency. Whatever financial planning you are doing, you should try and improve your tax efficiency to the maximum possible. The lesser taxes you can pay as allowed under the various provisions is better for you, because that much more money becomes available to you as an investable surplus. Inflation protection. When you are making an investment, whenever doing investments, you have to choose asset class, or so as to say, your overall portfolio should work in a way that the returns are at least 4 to 7% more than the inflation. And now inflation is not just the wholesale price inflation, which regularly comes as a government figure, but also take into account the lifestyle inflation. What kind of a lifestyle you lead, and how is your lifestyle inflation going to be different from in future to come? You'll have to make those assumptions, calculations, and some kind of broadcasting there, so that you take into account that if the wholesale price index inflation is, let's say, around 6%, 6.5%, 5.5%, and if I am leading a lifestyle which is slightly higher than that, if my lifestyle inflation is around 7%, I should be making my investments in a way that the overall portfolio gives me at least 12 to 15, 16% returns. On the other hand, the next point is capital preservation. We are going in an anti-clock direction, having started from tax efficiency. When we talk about capital preservation, you have to keep in mind that don't become a rate chaser. That is to say, that don't try and chase very, very unrealistic or high rates when you're trying to build your investment portfolios. What is important here, or what I'm trying to point out here, is that do not try and do active tradings, especially trading in share markets or derivatives or cryptos and even real estate, because there are consistent and unfailing evidence which proves that trading has usually, in the long run, you could make some money in 3 months, 6 months, 9 months period, but in the long run, trading usually brings losses for retail investors. If you are in an active job, if you are in an active business, you will not really have the kind of time to be an active trader. And trading should usually, if at all, is recommended only for people who do that as a full-time job. If you are investing money which you earn from your salary, or which you earn from your other professional expertise or your business, then it is advised, don't get into trading, don't become a rate chaser and get into very lucrative schemes. Be a moderately conservative investor, build your wealth over a period of time. So be very particular about capital preservation. Next is ease and comfort. Please do not get into asset classes which can give you a lot of heartburn, a lot of headaches, a lot of difficulties, too complex, unregulated. One example could be crypto. Another could be, unregulated real estate, or real estate which you don't understand. And I am personally a real estate practitioner, and that's why I'm saying, if it does not give you ease, do not invest into it. So get into asset classes only where you have a considerable ease, understanding, and you have people or practitioners, or so as to say, advisors whom you can trust and who are competent enough as per the asset class with whom you can work. Finally, financial sufficiency. So all your investments should be worked in a way that when you need them for different goals for longer periods of time, you're not falling short of money needed. and you are financially sufficient at any point in time. This is especially applicable to those who do not have a government pension. If you do not have a government pension, your financial planning has to be done in a way that at any point in time you're not wanting for meeting your regular cash flow needs. So what is the recommended strategy for meeting these five broad objectives which we just now discussed? One, goal setting. When you're deploying any kind of a corpus, whether it is a monthly amount you're putting aside or you want to invest your lump sum corpus which you have received as a part of your retirement or severance. So, goal setting, you should first be very clear about the goals for which you want to make investments. Investment is, I mean, when people say that I want growth, yes, you want growth, but in how much time, what should be the amount, what exact financial question are you trying to answer by making this particular investment? Then, to protect your investments against some kind of a huge volatility or against some kind of a unforeseen circumstance or some kind of a market movement which no one can predict, a diversification into different within the asset classes, if possible, diversification helps you in terms of capital preservation. It also kind of brings you down in terms of reducing your yield by a couple of notches here and there, but still, zero diversification or too low a diversification can land you into trouble. So, if I am very aggressive in terms of my investments, unless until I am an completely hands-on kind of an investor, and if I put everything in equities and if there is a market volatility, it can trouble me if the markets take a hit due to an unforeseen event. Therefore, some amount of diversification does, which is not to say that one should be overly diversified, because if you're overly diversified, then the problem becomes that you're not generating enough yield on the investments you make. Third, tailored portfolios. All of us have certain requirements which are unique to us, and all of us have certain ways of looking at various asset classes. Some of us are very comfortable with real estate, some of us are very comfortable with mutual funds, some of us are more, we have a preference towards maybe the more classical way of investing or the more conservative way of investing, which is a gold heavy or a debt fund heavy kind of an investing. So our portfolio should be tailored to meet our specific preferences, our specific requirements, and our specific risk appetite. Then rebalancing. Whenever you are doing your investments, you should kind of after 6 months to a year continue to have a look at them as to what they were supposed to be performing. Are they meeting those benchmarks? How are they performing when you compare them with other peers? And then you take a call whether it is something which you need to rebalance, shift, increase some, decrease some, and so there has to be a review and rebalancing of your portfolios periodically. Recommended is 1 year, and reviews are every 6 months, and recommended rebalancing every 1 year. Finally, hybrid of growth with safety, as I covered earlier. Do not be a rate chaser, but also do not be someone who is so scared of making investments that you're not meeting the required yield so that you're able to beat inflation and have capital efficiency. So, how do we go about it when it comes to our clients? And we have a 5-step process. Step one is we collect the client's data. I'll just read through this slide. There's nothing much to share here. We do data collection, we process the data for our clients, then we do a risk assessment for them, that what kind of a risk they have based on their age, based on their incomes, based on their present liabilities and obligations. Then we have a goal discussion with them. Then we process this data using our internal softwares, and then we provide a first financial planning draft to our clients. Once we have done that, then we set up the plan that as to where how much money needs to be put up. This then we also incorporate the changes based on the client feedback and whatever additional information we give them. Then we prepare a final financial planning draft, and we take the client's assent on the financial planning. We go on to step three, wherein there is an asset allocation. Now, whatever as was decided, let's say I want to start an SIP for my child's education and also an SIP for creating a long-term corpus for my regular incomes once I retire. So then I start allocating assets as per whatever the decision was If I want to buy a house, then I start allocating assets there. So we set up the investments, we set up the systematic withdrawal plan if it is a retirement purpose, which I am allocating with reference to, let's say I retire, I have to invest once a year, and I put 60, 70 odd lakhs in a particular kind of funds and another 20, 30 lakhs in a particular kind of funds. And now I want to withdraw from that fund on a monthly or a quarterly basis to meet my cash flow needs. So we set up a systematic withdrawal plan there, that how much would be extracted or how much would be withdrawn from this particular segment of investments which I had done. Similarly, if I'm putting up a lump sum amount, say it could be my severance package, it could be amount I have uh, saved over a period of time, and now I want to deploy it in, say, equity-based mutual funds, which can have some amount of volatility over a period of 1 year to 2 years. So what I do is I put all this money in a systematic transfer plan. That is, I put all this money in a debt fund based two, three instruments, and from there, on a periodic basis, on preset equity mutual funds, which have been discussed and agreed upon, we keep on transferring amounts from there. So it becomes a systematic transfer plan on a prefixed date or of the month. It keeps on being put into the equity based mutual funds. As a result, it's able to overcome the periodic volatility which may occur, and therefore my capital is preserved. And if there is a need to start the SIPs, we start the SIPs. Step four is evaluation, which I said that every 6 months to a year, we do a periodic review, we come up with new recommendations, and then we manage the performance of the portfolio as to whether it is something which is meeting what I had set it out to meet. Is it approaching the goals which I had set it out to approach? Is the direction of the investment right? Is the rate of return what I hope it to be? And if not, then what changes are needed to be done? And step five, if everything is right, I don't change the portfolio. If there is a need that the assets need to be the asset allocation needs to be made, needs to be changed, then we make those changes. If there have been material changes in the market conditions, then we utilize the market conditions for our benefit either ways. If we need to increase more on the debt side, if we need to more on the equity side, if real estate market is showing promising green shoots, or if we envisage that there are certain sectors in real estate which are going to be performing in next 8 to 10 years, and we make some shifts there. So we review our portfolios and take actions accordingly, and also plan fresh investments on a periodic basis. Calculations here today. So this is the first step of financial planning, your personal income and expense sheet. I had recently shared article also on this, the Pehla Kadam, or the first step towards your financial planning is not where to invest, what to invest, etc., but measuring your own income, your own expenses, and understanding your internal patterns as to it's like, if I want to be healthy, then what kind of diet I am taking, what are my sleep patterns, how often do I exercise, what kind of a time do I give to my personal needs, what kind of time am I working. So once you have those patterns, then you can decide that how would I cater for my health. Similarly, if it is your financial planning, then you need to have your personal balance sheets, and these should be regularly, the data should be provided to them regularly, so that you can see your own patterns. What are your major expenses? What are the expenses which are discretionary and can be controlled over a period of time? What are the expenses which you can probably do away with? So those kind of things. So this is a suggestive sheet wherein the expenses are on the left side. What is the rent or the mortgage I'm paying? My car loan EMI, my fuel and transport, vehicle repairs, how much money do I spend on my vehicle repairs, the school and college fee for my kids, my monthly messing, food, nutrition, groceries, etc., loans, EMI. So the sheet, I mean, this is just a suggestive sheet. It can keep on going. It should be a fairly detailed document for any household. Surprisingly, our experience has been that 95% of people do not maintain a expense sheet or a ledger account of their own expenses and their incomes. And this is not something which is going to help you in good stead in times. So it is a request and a recommendation that please start maintaining your personal ledgers. You probably would at times not even need a financial planner. This document itself can help you understand so many things about your own patterns of managing money. Then on the right hand side is the middle column is investments. What kind of a recurring deposit or SIP you are doing? What are the property investments EMI? And now here I'm putting property investment EMI, which is a separate column from the rent and mortgage of cell phone house. This means this is the second or the third or the fourth property which you have purchased, and this is not the property or the house in which you are staying. So this is a property investment which I have done with a particular goal in mind. Any other investments you are doing, which could be a gold bond, which could be a government scheme, etc., etc. And then this is where your incomes are being put: salary, pension, dividends, rental. And then you will see that after you have combined here in this column the total of expenses and investments, what is the surplus or the shortfall from your monthly incomes or the yearly incomes, and how this is the amount which you can now take forward and plan on your finances. The next sheet here which we have is so this is a very simple workable Excel which kind of works as a self do it yourself tool. Let's say this is me, Vipul Choudhary, my age is 45, number of dependents 4, including me, and my monthly income is, let's say, 2,50,000, monthly expenses are 1,60,000. My home loan EMI is 30,000, car loan is 20,000, or maybe do not have a car loan presently. So let's say, or I have a smaller car, let's say, keep it at 10,000. So, and my total outstanding loans are 25 lakhs, including the home loan and the car loan. So my emergency fund requirements broadly are around 6 lakh rupees, which is the total of monthly expense and the EMIs which I'm supposed to be paying into around multiplied by 3. So I should have at least 3 months of emergency fund as a contingency fund, which is the outgoes on a monthly basis, including my loans and my regular expenses towards my dependents, my food, messing, which is the data which you should be gleaning from the first sheet which we had discussed. Then ideal monthly savings for me to be able to meet my future expenses going ahead. Ideal is around 62,500 as per the sheet. And now we go ahead, we come down. This is a 4 monthly equation. This is a recommendation that, if you are someone who is not able to, whose income and loans is equal to expenses, then your financial situation is not very good. Anyways, moving on from here. So this is a very broad calculation here. What kind of life insurance cover I need if this is my present financial situation? It is approximately 2.3 CR of a life insurance cover I will be needing at this particular situation. Health risk cover of around 10 lakh rupees is what I need. Now, if I'm making a investment of 20,000 rupees a month in equity and real estate, and a debt of around debt investment of 5,000 rupees, then total monthly investment of 25,000 rupees, my expected returns are around 10.8%. This is a suggested equity oblique debt portfolio at my present age. If I am earning around 2,50,000 rupees a month, and if my expenses are around 1,60,000, and I have additional EMIs of around 35,000 rupees. So this is one sheet which is a do-it-yourself sheet, which kind of gives me an idea as to how much should I be making an investment or a monthly breakup of the investments I can be making for meeting my financial obligations in the times to come. Next is, if you have just received a corpus from your employer on retirement, then what can be done to how you can invest that. So what we have done here, we have kept the corpus amount at, let's say, around 1 CR. And if you are doing a 1 CR corpus with, this is the moderate return here, which is wherein equity or real estate or both mixed, around 57% has been invested there. Debt around 17 lakh 20,000, that's around 17.2%. 17.2% has been invested in gold. Liquid funds has been kept at 8.6. This could be liquid debt funds, this could be fixed deposit, this could be simple money in your savings account. And the total investment at 1 CR, expected returns are around 11.47%. For a conservative investor, the portfolio mix has been changed, And now equity real estate oblique, equity oblique real estate has been pulled down to 45%. So it's at around 45 lakhs. Then debt has been increased to 30% at 30 lakhs. Gold is now again on the higher side, 15%, 15 lakhs. Liquid also has been increased to 10%. So it is around 10 lakhs. The portfolio returns are now at around 10.45%. Then there is a moderate risk, which we had already covered. Instead of 57%, we had put it at 60% into equity real estate and 20% towards debt, gold towards 10 lakh, and 10% liquids at 10 lakh. The rightmost is aggressive, which is especially for people who are slightly younger age in profile. They can have more aggressive portfolio mixes because they have time for the money to grow and they're still earning money from their regular work, which could be whether you're in an employment, or you're self-employed or a business, you're still working actively and making money. So you can take more aggressive positions and your contribution towards equity and real estate can be on the higher side. So if I'm putting 80% in equity and real estate, around 10% in debt, 5% in gold, just to kind of hedge sudden movements of equity or real estate, and 5% in liquidity for meeting my contingency requirements, as we had discussed in the earlier one. So my total investment of 1 CR, approximately 13.3%, 13, 14, 15%. This works out to approximately 15% over a long period of time if I'm invested with this kind of an aggressive portfolio for around 20 odd years. And I can generate sufficient wealth for meeting my requirements in my senior years or for meeting my financial goals as a retiree. So we'll come back to the presentation, the balance part of it. These are some suggestions of as to how you can plan your investments, whether in lump sum or in on a monthly recurring basis in form of SIP, etc. So goal setting, what are the four financial stages of retirement, especially applicable to those who are looking at retirement or those who are now at 45 middle ages. When you're in your 45 to 55 years of age, you're discharging your obligations at the peak of your career, wherein you're getting paid maximum, especially if you are in salaried employments, then you're now at where you probably would be highest in terms of your professional expertise, and as a result your incomes are also at the highest level as of now. When you are in the 55 to 65 years, you are still discharging some of the obligations and you are now in a pre-retirement stage, and you could be working, you could be earning actively, but now the thing is that your earning potential is now coming down from what you could or what you were earning till 55, 60 years of age. 65 to 75 is when you are in your early retirement stage, and this is when you should be consolidating your assets, focusing more on cash flows to you, focusing more on having liquidity around you, and having comfort with your investments rather than wealth creation. 75 to 85 late retirement, you should not be getting into too many aggressive schemes or too much of investments which can kind of result in you getting illiquid at this stage, because then it can be a great stressor for you. Two important SIPs, especially for people who are advanced, if you're not able to obtain a health insurance because of, let's say, your age is not allowing, or you have some kind of a pre-existing disease, insurer is not ready to give you an insurance, you can then the amount for which you wanted to start an health insurance, you can in lieu start an health SIP. So you and your spouse, both of you can have an SIP specifically for meeting your health insurance requirements. Similarly, if you're retiring now at 45, 50, 55, and now you have had a life wherein you worked very hard, you have been a responsible person, financially you have taken care of your family, it is probably time to start putting aside some money which you can spend discretionary after every 3 to 5 years. We call this as a YOLO SIP for our clients. We call it as a you only live once kind of a SIP, and this is a money which you can should and you spend on yourself without feeling any guilt about. These are the suggested asset instruments when you are making your asset allocation. Step three, which we discussed earlier, growth is going to come to you from real estate and equities. There is no other way by which you'll be able to get growth in your investments. There is no other way you can generate sufficient assets to meet your obligations or your goals. You got to understand this mathematically. If I'm earning, let's say, 100 rupees a month and my investable surplus is 30, there is going to be a time I'll not be earning that 100 rupees. So this 30 has to be invested in a way that when I'm not able to earn 100 by expenses at that point still there, this 30 has to grow in a way that it meets my expenses even then. Therefore, I have to put it in investment classes which help me create and develop those assets over a period of 20, 30, 35 years of saving and growth. And that growth is only going to come by equities and real estate. It is not going to come by fixed deposit. It is not going to come by debt. It is not going to come by gold. Yes, you can have some kind of a stability or a balancing factor in your portfolios, which comes from debt funds, which come from the conservative government schemes, which comes from gold investments, which come from more traditional investments, or rather to say more debt oriented or more conservative investments. So they are there to provide stability to the portfolio and meet your moderation needs and not to generate wealth. Whenever you are making a lump sum payment, ask your financial planner that they should use the systematic transfer plan route so that interim or the short term volatility can be managed and you do not see your portfolio going up and down too much, which can cause you a lot of stress. Whenever you are monitoring or rebalancing your portfolio, especially important to review your equity and real estate portfolio so that if there is a need, you are able to rebalance or monitor it. And if required, if you have, there have been times when there have been changes in interest rates, and as a result, your debt or the fixed income portfolio, if it has gone down, then you need to change your SWP method. Now, this is a lot of people ask us, should I be investing in equity and real estate? Well, I would say yes, because growth is needed for long term capital preservation. If you are not developing assets which are going to keep on generating long term self generated income for you, then you'll not be able to be capitally sufficient in senior years. And the only way to do that is by investing in equity or big real estate. We are neutral in terms of whether it equity or real estate, but we are not recommending that for wealth creation you should look at anything other than these two classes. So you can just read through the slides. And the fourth point is very important. Dividends and rentals are a very, very important way of generating the regular income, especially for people who do not have government pensions. So if you are some of those who are 35, 40, 45 and not in receipt of government pension, this is the time when you start generating or developing asset classes which will give you regular annuities or dividends or rental yields in times to come. Commercial real estate, if you are able to make good commercial real estate investments, then it can give you the stability of a debt investment and also the capital appreciation of equity. The only thing is that when you are making commercial real estate investments, you have to be even more sure because the participation of organized players such as banks, etc., is low. So the risk quotient goes high in commercial real estate. Therefore, it is required that you get in touch with people who are more tuned or who are more clued up in terms of helping you make the commercial real estate investments. Should I be buying life insurance? Another question comes. I would say this is a very personal question. Understand your liabilities. If you're 60 years old, if you already met your liabilities towards your family, if you already have created assets which are going to be sufficient for meeting your and your spouses or your dependents, if there are still dependents, long-term needs, then you don't need to buy insurance. If at all you need to buy life insurance, then it should be pure term life insurance. We have covered a session also on this. Please do not get into plans which give you that fixed returns and guaranteed returns, and they're all endowment plans or ULIPs by insurance companies. They are generally pushed by agents because agents tend to earn a lot of money in insurance products, and they're a poor combination of insurance and investments. It is better that you adequately insure. If you're not, go for a term insurance plan. That's an economic way of insuring yourself so that in the unfortunate event of you not being there, at least there is sufficient money to take care of people who are financially dependent on. This is more specific to central government and armed forces officers who are employees with central of the state government. Should you be commuting your pensions? Yes, we have done adequate research on it, and we have realized that commutation of pension is an attractive cost of money. You get a 15-year upfront money by commuting your pension, and we have done a video on this earlier wherein we recommended that you should be commuting your pension. So if this is applicable to you, please commute, especially if you are younger, if you are seeking voluntary retirement, if you have 45, 50 years of age, then this becomes even more attractive because the younger you are, the better are the terms at which the commuted amount is given to you. For more details, you can visit our channel and have a look at the commutation video which was done there. It's much more detailed there. You can invest the commuted amount in high yielding asset classes such as equity and real estate and generate more beneficial returns for you as compared to taking a regular pension. Commuted amount can also be offset to pay any high interest loans which you probably are servicing. If you have a home loan, if you have a property loan, then you can use the commuted amount to pay off that loan and you'll be better off. Although if you're a special category pensioner, say if you have a disability pension or if you're a proud gallantry award winner, then commuting is something which needs to be discussed with your financial planner, because the fact that you are not liable to pay taxes on your pension is a strong indicator that commuting will only be beneficial if it is put into more aggressive investment classes. So there you should take a call in consultation with your investment plan. Now, this is a question which has come often, that in the budget which was passed by the finance minister recently, the indexation benefit from debt funds has been removed. What was the indexation benefit? Earlier, the indexation benefit was that if I keep my money invested in debt funds for a period of 3 years or more, then the inflation indexation was allowed to me to be reduced from the total growth in debt funds which was occurring to me. Now that particular benefit has been removed for the investors for debt fund. Now what this has changed? This has changed that the yield will reduce in debt funds, because earlier you could reduce the indexation or the inflation indexation from your final yield of debt funds. Still, debt funds are a good investment option at times. Not at times, carefully chosen debt funds give you a moderation in your portfolio, and they also give you the required liquidity if need be, and they are money on call if you want to withdraw and fulfill some of your contingent needs which may come. Yield has reduced, so a lot of people are now also looking at REITs, real estate investment trust, and fractional ownership in real estate, so that they are able to get the yield of debt funds and still have the indexation benefits or the benefits towards capital gains in if they need to sell these assets. A lot of our clients have shifted to fractional ownership, real estate, and REITs as I would say as a replacement for debt fund investments, though not completely, but there are people who are doing that. So alternative to debt fund is fractional ownership or REITs in commercial real estate, higher rental yields, capital appreciation, and you still get the indexation benefit. But again, this will depend on individual to individual. You should take this decision in consultation with your financial advisor. Recommendations for people who are doing their financial planning: first, please include your spouse in all your financial planning process, so that one, he or she is aware of as to where your money is, what is being done, what are the planning parameters, etc. If you are now progressing towards your senior ages, please try and bring your loan liabilities or rework your loans in a way that by the time you reach 65 years of age, you're completely loan free. Prepare a list of your financial documents and keep them handy. This is a very important step here. Please do a 2-hour exercise. All it needs is you need to go to your Gmail account, open an Excel sheet, and create 4 or 5 columns. The document type, originator, whom to be contacted, etc., etc., and share it on your spouse's Gmail account or probably your children's Gmail account, and it becomes a document which is there for them to be able to use if need be. Reduce your financial complexity. Don't try to have too many things going. Simplify things for you. Use technology to simplify things for you. And I mean, don't be too much of a paper and pen person, because then the searchability is difficult and you keep on getting. So whatever paper files are there, try and convert them into electronic data. which can be done very simply for most of the individuals using simple tools such as Excel sheets, Google spreadsheets, etc. For those of you who are now approaching senior citizen status, these are the three recommendations. Consolidate your real estate. If you have real estate spread over a lot of places, start liquidating them and start getting that money back into your bank account. Even if you want to buy real estate with it, try and buy real estate which is in the area of 50 to 100 kilometers of your primary residence, so that if need we are able to manage it better. Prepare your will and get it registered. We had covered a session on will with advocate from the Supreme Court. That would again be live on the channel in a few days. You can look at it. Start having fun, engage socially. Obviously, you're now in your scenarios. This is something which is very applicable. This particular slide, I would like to the short service officers or people who are not in receipt of their government pension or any kind of a pension, they should be very, very particular about the fact that their primary goal of their financial investment has to be creating assets for pension, because pensions are something, if it is not there, you are going to face a lot of challenge in your senior years. So start working towards developing a pension plan. And if you have still not purchased a house, परचेज अ हाउस. डोंट बॉदर अबाउट द फैक्ट कि मेरे को कौन सी लोकेशन पर लेना है. मैं तो बॉम्बे काम करता हूँ. Why should I buy a house in Firozpur, where I belong to? Buy a house wherever your means permit you, because you'll anchor yourself. A major question of your financial life gets answered, and it will bring you a lot of peace. And you can continue to pay rent wherever you're working right now. And your house you can put on rent, and you can go and settle there once you retire. So buy a house. Don't delay that decision. It will bring you a lot of peace, stability, prosperity, and financial growth. And I say this from a lot of experience. Please buy a house if you are 35 and you have still not purchased a house, wherever it may be. Not necessary that you buy a house in NCR or Bangalore or Hyderabad. Don't get sucked into projections about growth and etc. etc. Buying a house is a more primal need. It helps you stabilize, it helps you gain confidence. So buy a house with whatever budget you have in a city of, if you're not able to buy it in a metro, then maybe go to a tier 2 town and buy a house. You'll be better off in times to come. You have to understand that if you're a non-pensioner in any kind of a job, whether you're in a corporate job or you're a short service commission officer in the Indian Armed Forces, or you are a central government employee after 2004, that as compared to your parents, if they were today and if they are in receipt of government pension, or as compared to your peers who are in receipt of government pension, your incomes have to be 40% more than what they're earning, so that you're able to meet your financial obligations. That is the impact of not having a pensionable employment. People, you'll need a financial advisor, a property broker, a reasonably priced advocate, and a reasonably priced chartered accountant. These are the service providers you'll need. And this is the last slide, which is an advertisement, a blatant advertisement of what we do. Why should, if at all, you choose to work with us? Because we have been in the industry for a fairly long time. We are now in our 17 years of operation. My business partner, who is a SEBI registered financial professional, has 17, 18 years of experience. I've been in the industry for around 15 years. My core is real estate. His core is financial products. We have the widest product mix. So it kind of balances our recommendations and our advice. We are not biased towards a particular asset class. And therefore, we are able to give you pros and cons of all asset classes and then help you decide something which is more suitable for you. You will not find us talking about the fact that real estate is bad or mutual funds are good or mutual funds are bad and real estate is good, because we are able to provide you all. We have you have a single point of advice for, single point for all kind of expert advice. We are very detail oriented, so we get into deep data processing and understanding your needs and accordingly giving you advice. We use technology at a fairly generous scale. Therefore, we are more updated in what we offer. Our product offerings are very wide and large, and we continuously engage our clients, so you're not ever left without an expert and comforting hand to help you with your financial planning. I am done with my part.
on yourself, on your faith, on your dreams, on your mind.